I want to bring in David Zervos. He is Jefferies Chief Market Strategist. He's joining us from Florida. David, I do want to talk to you about equities, but I got to start with oil because of what we are seeing today. And I know when it comes to some equities, you're saying you want to buy the dip. Would you want to do that with oil right now or oil stocks, for example?
Well, first, let me be clear, Julie. We recommend buying equities only with a hedge, and the hedge is for many years, our hedge has been in the interest rate markets, but with interest rates all at zero, we've had to kind of get more creative in the last 3 to 4 weeks. And what we've done is moved our hedge to the short end of the investment grade credit markets. So what we do is we have a long position in short end investment grade credits, single A's and above, so nothing even triple B, which were at the time when we went back in yielding about 200 over treasuries. We leverage that up as our sort of risk parity hedge to a long equity position. So we're not naked long equities. We still think the Fed will pull levers in a downturn in the economy and a downturn in the markets, which would probably be somewhat synonymous with each other at this stage. And that lever, I think, is the only lever that you can really see them pulling that has a market impact is in these investment grade bonds, because they're done with treasuries at zero rates. The QE at the long end isn't really a viable hedge. And so we're looking at that as the way to play it. In terms of your question on oil, I'm not a commodity guy by training, and I do look at it from the global macro perspective. There's a lot better guys on the intricacies of the oil market, but this first contract just traded down to $10. I think the second contract's at 23, the third contract's at 26. So the oil market is basically saying, hey, look, we got a big storage problem. You guys, nobody's buying this stuff. Who knows? If it was a few more days in this contract, maybe it could even go, as my friend Pierre Anderon said, could go negative. And he's probably one of the best oil guys out there. So I think, you have to take this all with a grain of salt. The back month, futures, 1 year out, 2 year out, 3 year out, they're still showing $30 to $40 prices somewhere in that region out in 2022. So it's not a complete meltdown, but it is, look, that price 30 to 40 is not going to sort of make a lot of people a lot of money, and certainly the Bakken or anything else. And we've seen bankruptcies accordingly down there. So it's still low, but I think this particular move today is much more of a specific move to the very front contract and the storage problems associated with a complete collapse in short-term demand.
Hey, David, it's Julia LaRoche. I want to come back into, what we know U4 is watching the Fed, and you often talk about the Fed, and it's not what they should do, but what you think they might do next. We've seen so many moves in recent weeks. What do you think might be the next move for them, and how would that kind of play into the trade you were just referencing about the equities with the hedge tied to investment grade?
Well, I think the place that the Fed really has kind of left a bit high and dry here, and I want to leave the leveraged part of the corporate market out, because I think they are meaning to leave that part out. They're not going to go and take a company that's 8, 10, 12 times levered and give them a lot of help. They see those as probably institutions that flew a little too close to the sun, and they're probably not that interested in bailing out that kind of business model. But the residential mortgage market is really a place where there's been, in my opinion, a real lack of focus by the Fed. And it's a place where we've had pretty good lending standards compared to where we were 10 or 12 years ago. They fixed it. But the AAA pieces of non-agency residential mortgage bonds are still 200 plus over. You could say the same in commercial as well, although they did address that somewhat. But they're only focusing on the agency markets. And that really doesn't help very much the homeowner just by driving up secondary prices for mortgage pass-throughs. We saw this last time. It doesn't get a lower rate to the household. And the Fed is in there getting loans to small businesses. A guy owns 12 gas stations in Texas. He's getting a loan. A guy owns 12 restaurants in Kansas. He's getting a loan. And they're going into their banks and they're getting loans for these small businesses. But what about, the guy that's got a mortgage that's at 4, 5, 6%, still in good credit, still in good standing, has a job or is refocused and got a new job, and he's trying to get a lower rate or refinance his house with these new very low interest rates. And guess what? The bank's saying we're not interested. And that's really what the banks are saying, because the origination machine is largely broken. And there's a variety of reasons why that is, but the Fed could come in very easily and fix that. And I think their next step, my personal bet is their next step is something in the residential mortgage market. It's also going to play well for their image. Their image is trying to become more Main Street focused. And what better way to help Main Street than to sort of force through a refinancing of a bulk of mortgages. And remember, Julia, this is a big market. This is bigger than the corporate credit markets. It's bigger than the muni markets. It's a $10 trillion debt market that is primarily a Main Street market. It's not a Wall Street market. And I think focusing their stimulus efforts on buying secondary is just going to backfire like it did last time. And so my guess is they're looking at it, and I'm hopeful that they do something there, because I think it could be a lot of stimulus. You get 100 or 200 basis points lower on mortgage rates for people, whether it's short-term or long-term, however they 15-year, 30-year, or some sort of adjustable structure for a while. You can really help people out.
David, when you look at not only mortgage-backed securities, but let's expand this, though, to what's happening in commercial real estate, doesn't the Fed, though, face a double-edged sword? Because we had a guest on within the last 20 minutes who talked about their concern of disinflation. And with all of this refinancing and so many Americans having to sit on the sidelines, aren't we going to see a reset, not only in commercial real estate prices, but also in our homes, in residential real estate?
I think there's a real risk to that. There's no question that prices will be soft, and that, I'm a big believer in the disinflationary forces that were here before the virus. And I'm an even bigger believer in the disinflationary forces after, because I think the aggregate demand side is much more important long-term for inflation than is the supply side, which could be temporarily inflationary. So I'm sympathetic to that view. But you're talking about a mortgage market which is either agency backed, so a large number of these are already backed by the government. I think 5 trillion, half the mortgage market. The other part is that the Fed could come in like it's done in the past and sort of backstop that AAA piece in the structured credit markets. This stuff is trading at 200 plus over. If you don't have a well-functioning AAA mortgage market or slice at the top of the structured product, there's no way new origination will take place. And that's where we sit today. The Fed is coming in and doing AAA CLOs. The Fed is backstopping, at least legacy at this stage, AAA CMBS. They're doing it in autos. They're doing it in dealer floor plans. They're doing it all throughout the TALF. Why are they not doing it for residential mortgages? I don't understand. It is mom and pop. So that's why my bet is they'll do it. It's trickier. It's a more complicated set of securities. I get it. And last time around, they didn't do it because things got better really quickly after they did a lot of other stuff. But I think that's what's coming, and it's likely to be quite helpful. And I don't think the agencies, Fannie and Freddie or FHFA or FHA, can really do what the Fed can do with its balance sheet to help a refi wave. So that's the way I'm looking at it. I think that's next. I think that's pretty positive for some more stimulus to the households, and maybe less of a focus on this idea that, the Fed's next going to buy equities. I think this idea that the Fed's going to set up an SPV to buy equities, they could do it. I'm not going to say they can't. They certainly could. That's going to just smell so much of bailout for Wall Street, leaving Main Street aside. So I just think they're going to be much more cognizant of that smell test with the American public. And they've done a good job so far with the Main Street funding facility. I think they just continue on it.
Hey, David, Rick Newman here. Can the Fed ever raise interest rates again? Not an entirely sarcastic question, basically just trying to say, do you foresee any time that the Fed can actually tighten monetary policy again?
I remember those questions in 2012 and 2011 and 2010, and we're never going to get out of this, and this is going to end. We're either going to be Japan or we're going to be Zimbabwe. And guess what? We raised rates. We raised rates almost 250 basis points, and then they went a little too far. They got a little sort of cocky with it, particularly Jay Powell back in Q4 of 2018, and they went a little too far, and they had to turn around and they cut 75 basis points last year. So I think the answer is absolutely yes, Rick. they'll definitely raise rates again. And the best sign that things are working and that people's expectations are that we are going back to some sense of normalcy will be a steepening of the curve and a selling off of the back end of the curve, the 10-year and 30-year yields. That'll be the sure sign that we're expecting some form of normalization/recovery. Without that, we're going to be very low rates at the long end are really going to signal that we're just Japan and we're not going to get out of it. So I think that will take time. I don't think the market's ready to price that in just yet. We have a lot more to learn about this virus that none of us know anything about in the field of finance. So we're a bit enslaved a little bit by the science and the epidemiology, which we don't know a lot about. But I feel pretty confident that we find some way forward that gets us back to a partial, if not full normalization, but maybe a different normal. Maybe we're not all going to the movie theaters. We're doing things more like we're doing them today, where we're going to a more virtual society. And maybe that's actually a very positive thing. It certainly fits with the technological views of disinflation as well. So I think the one underlying view is that there's a lot of disinflation. And the Fed is using that today, all of that disinflation that's been embedded in the system and the new disinflation to give us the windfall that allows them to do these programs, which are really cushioning the blow of this very, very nasty supply side shock.
Well, David, it's Julie again. Speaking of those programs, you put out this note, and I love this note. You're talking about some folks who are just kind of, losing their cool over one in particular, especially when it comes to the high yield ETF inclusion. Are they justified in their frustration when it comes to that?
Look, I can be, and I said in that piece, Julia, that I'm somewhat sympathetic, and I'm usually not very sympathetic to the kind of the sort of burn down the system hater mentality. And I do think a lot of those folks are really using this virus to sort of claim victory on a recession, which would have never happened had we not had this natural disaster. So I find that whole line of thinking of, this is the time to change the system and burn it down sort of thing is just a very repulsive thing for me. I don't buy it whatsoever. I think we were in a very good place coming into this. This is not about financial markets failing. This is about a real natural disaster. And there are ways to fix certain things, and you never want to let a good crisis go to waste, but this isn't a failure of finance or economics. It is just a tragedy. And a human tragedy. So I think the way we want to think about distributing the stimulus is a sort of a real decision on what's equitable in this time. And like I said, we're not really doing anything to help mom and pop get a lower loan on their $250,000 or $300,000 mortgage, but we are, basically giving funding to the levered loan space, for example, or the highly levered HYG structure, which happens to have, I think, still 5 or 6 companies in it which have declared bankruptcy, and they'll be moving out of the index, but they're still in there. So it just strikes me that these are equitable distribution debates that need to happen, and I can understand the frustration that many people have. And I personally, while I don't like to say what they should and shouldn't do, I like to comment on what I think they will do, because it's the only way we sort of generate alpha, is that I think there's probably a lot of politics that went into the Fed, including some of those more levered places in the corporate industry. And maybe that's coming from Congress and the administration, but very likely from Congress. And I think the Fed is probably much more suited and much more, what's the right word? It just fits the Fed mandate much more for them to start with the higher end of the capital structure and fix that and work its way down. And it's got plenty more of that high end capital structure to work with in places like the residential mortgage market before it needs to go in and buy high yield and equities. So I'm somewhat sympathetic to that. And look, I worry like everybody about the Fed's image. I was very worried about it post 2010 when I left the Fed, that they were going to get this stigma with Main Street versus Wall Street, and it really did stick. And I used to write a lot about it. I'm worried that they do it again. I think they're in a better they have a better understanding internally of that now. So I'm happier about that. And that's why I project they will be more focused on Main Street in these programs that come. But, I do worry, my pedigree is, it's like my alumni. I started there in the early 90s. I went back in 09. You don't like to see the university that you came from or the alma mater that you came from, doing things that don't make a lot of sense or maybe reducing the credibility of the institution. So I do have that bias in me. And I think there's some risk to that as they go down into into the nether reaches of the distressed lending area. It's just an area that's not really easy, I think, for one to explain why monetary policy and even monetary combined with fiscal needs to get to. There's a lot of things they can do before they really need to get down there. And one might argue they never need to get down there.
Right. Well, I guess they're feeling a sense of desperation, like many people are right now, when they're trying to figure out how to tackle this and throw everything at it. David, it's always good to see you. David Zervos is the Chief Market Strategist at Jefferies. It's good to get some time with you. Thank you so much.
Thanks for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.